Hey there, everyone. Happy Friday. It's September 27th, and welcome to this special all mailbag edition of Chart This with Dave Keller, coming to you from the kind of cool but beautiful Redmond, Washington. We had an awesome hike out in the forest after the show yesterday, which was pretty good. A little bit wet conditions, but still pretty livable here. Today, what I wanted to do was just answer some of the great questions we received on the show so far. This is our second full week with the new show, the new format, the new look. I really appreciate all the thoughtful comments and feedback and encouragement I've gotten from so many of you. Really appreciate it. I'm excited to keep this going and keep making it better and better. I am enjoying actually including some questions during the course of every show, which has been a lot of fun. But I have way more questions than I can get to on any given episode. And so having a mailbag episode about once a week where we can take a little bit more time and answer some of the great questions we've received, I'm a big fan. So with that in mind, let's get to some of the questions we received here this week. Dave, you have a high yield spreads chart number 295 on your Mindful Investor Live chart list. Can you review this and what's the significance? 100% yes. So this is from the Mindful Investor Live chart list, which I do still maintain on stockcharts.com. By the way, if you want access to this list of charts, here's how you get there. Go to stockcharts.com. In the upper left corner, click on articles. In the upper right, click where it says all stock charts blogs and go to mine, which is called the Mindful Investor with Dave Keller. There's this button right here that says live chart list. This will get you to live versions of the charts that I'm about to show you. So the way this works is I actually have my own login where I can be managing these, updating all the annotations. And if you ever go to this link, if you bookmark it, you'll get the current versions of these charts. And so it's kind of a cool way to have a set of charts that we're able to review or that I'm able to create and update. And you can actually see what I'm talking about. So the chart that you're talking about, that you're asking about, is this one, high yield spreads. I'm guessing this is where I usually show it. So what does this chart represent? So here's a little fixed income 101, and if you're a bond investor or if you're in the fixed income markets, please give me apologize. I apologize ahead of time for how I'm going to completely generalize a lot of this. I'm going with a very simplistic explanation of what I know as a lot more moving parts than I'm implying, but for simplicity, here's what it is, right? If you're a bond investor, right? I mean, if you would invest in a company in some way, you kind of have two general ways you can do that. You can buy stock, which means you're a part owner of the company and you're benefiting from, the company doing well and the value of the shares increasing. And you also have a voice there, or you loan the company money and they pay you interest. And that's basically a bond, right? You're loaning the company your capital, and then they're paying you interest and then paying your principal back at the end of it. And that's what a bond basically represents. So a corporate bond is what how a company is able to borrow money from investors. A high yield bond, and I'm sort of getting to what this series actually represents. So sorry if you know all of this, but if not, hopefully this helps you make sense of it. A high yield bond or a junk bond is basically the bond of a risky company, right? So like a well-established Johnson & Johnson kind of company has been around for decades. They have a pretty consistent, pretty stable business. So the likelihood of them being able to meet their debt obligation, meaning their ability to pay your interest payments, pretty high, right? Because it's a stable company. Chances are Johnson & Johnson is going to be around for a couple of years. Probably should have no trouble paying you back the money that they borrowed. But a riskier company, something that's maybe earlier on, less established, less probable or less, guaranteed that they will succeed and be able to meet their obligations and not run into trouble, that probability is a lot lower. So the risk is a lot higher. So we call that a higher risk or high yield bond. And the reason why it's called a high yield bond is because bonds are quoted on a spread from a treasury bond or a risk-free bond, right? So if a risk-free bond is paying like 2% and the high yield bond is paying 5%, meaning they have to pay you a lot more because it's a riskier proposition lending this company your money, that spread, 5% minus 2%, is a 3% spread. And that's how high yield bonds, or really any corporate bonds, are quoted. They're not quoted in terms of price terms, they're quoted in terms of a spread over treasury. You call those corporate spreads. So high yield option adjusted spread is basically the spread for junk bonds or high yield bonds. So the spread quoted for bonds of risky companies, and this is using an index, so it's not individual companies, but aggregating together. An option adjusted spread means, some bonds actually have call options. They have different structures. And so this basically just means you adjust for all of those. So it's more of an apples to apples basis, looking at a bunch of bonds of a bunch of companies. That was a long-winded way of saying high yield option adjusted spread, or the high yield spread that we like to quote, is basically an index tracking where junk bonds are trading. So if you want to look at the high yield debt market, you can do two things. Look at HYG or JNK. Those are ETFs that track those companies or those, those bonds, and it's tracking the performance of those over time. Or you can look at spreads, which is what I like to do. And so this index is basically the spread that those high yield bonds are being quoted at. And again, using an index from Bank of America. So what does this mean? If the spreads are wider, meaning this number is getting higher and higher, that means bond investors are seeing a more risky environment. They see conditions as not ideal. They see conditions for the general market conditions as being more bearish. As a result, they are looking for more and more compensation for owning the bonds of these risky companies, because there's an elevated risk that the companies won't be able to pay their debt back. And so you need to get paid more to lend these companies your money. So widening spreads, or the numbers getting higher, mean fixed income markets perceive additional risk. When the spread is narrow, or the number is very low, that means bond investors are seeing kind of a low risk environment. They don't need a lot of extra compensation to own these bonds because conditions are pretty good and companies are probably doing okay. And as a result, that's, it's a narrower spread. So why am I plotting this upside down? Well, the reason is because when the spreads are narrow, when the numbers are low, that's usually pretty bullish for stocks. When the spreads widen, that's usually bearish for stocks. So I have high yield spreads plotted upside down. I have the VIX plotted upside down, and then I have the S&P plotted right side up, because lower VIX, tighter spreads usually means bullish for stocks. So now all of these series are moving along with the general trend in the S&P 500. So the reason why I have the chart set up this way is if you see the high yield spreads widening, if you see the VIX increasing, that means bond investors are seeing more risk. That means the VIX is indicating more risk using the index options market. And that usually means stocks are probably rotating lower. As you can see from this chart, the VIX is relatively low. The high yield spreads are relatively narrow. They're the sort of the lowest levels that they've been over the last 12 to 24 months. As a result, conditions are pretty bullish for stocks. Hopefully that makes sense as to what that chart is representing. That's probably the longest winded explanation I've ever given on there, but I get questions on that regularly. So maybe I can refer people back to this one. Next question. Can you talk about adjusted versus unadjusted data? Because my chart of AT&T looks different. Probably I could tell you what's going on. And I actually have a chart set up. I actually put this somewhere, just waiting for this kind of question to come up. But I don't remember where I put it. So let's see. We're going to real time find. Oh, here we go. Regular T versus unadjusted. Adjusted T versus unadjusted T. All right. Both of these charts that you see on your screen are AT&T. So how can they both be the same stock? Well, one of them uses adjusted data. One of them uses unadjusted data. Now, I'm going to tell you a little bit about what happens with data. And this is using stock charts as an example. I would encourage you, with whatever charting platform you use, and there's obviously many that you might have access to, different charting providers have different ways that they do this. And I know this, having worked at a couple of chart providers, having used a bunch of different platforms over my career, from retail platforms up to expensive institutional platforms. They literally all do it differently. And there's no kind of best practices or industry agreement as to how everyone's going to do it. It's up to every company to decide how they want to do it. And I'll come up with different ways, to be honest with you. But there are general ways that you can think of analyzing stock data. The bottom series, we'll start there, is AT&T. This is called the unadjusted data set. And whatever charting platform you bring up, this is a weekly chart just so we can see the differences a little better. Your weekly chart of AT&T might look just like this on whatever platform you start with. And the defaults can be different depending on the provider as well. What this means is you're actually looking at where AT&T traded over time. So, this is literally where AT&T was quoted at the market at the peak in November of 2019, right? And that's the actual dollar level that was quoted. If you hand updated charts, they probably would look a lot like this, because every day you're getting the data and you're drawing it on the chart, and that's how you're tracking the performance of a stock over time. But here's the problem, and this is why unadjusted data, well, I'll tell you what, the benefits of using unadjusted data are you're using exactly, you're looking at actual quoted prices back in history. If you see AT&T hitting a particular level, that's literally the level where the stock was trading. And so, the market has memory. And so if you're really focusing on support and resistance levels, that's usually a better data set to use. Now, what's the adjusted data and why is it so different, right? And I'll tell you, look at the differences, right? Here's where AT&T is traded right now. The November 2019 peak was around $30 a share. So we're obviously about $8 below that level. Here's the adjusted data, which is the default data set on stock charts and other platforms as well. If you look at this one, it looks like we're trading right at the November 19 high, because that is actually, according to the chart, was around $22. So why are these so different? An adjusted data set, this is what happens. Stocks like AT&T that have a dividend every quarter, what happens is when a company pays a dividend, you literally deduct the amount of the dividend payment from the price of the stock, right? So if they pay a 25-cent dividend per share, literally the price of AT&T goes down by 25 cents on that ex-dividend date when they pay the dividend out, because they're paying out a portion of the stock value as a dividend out to shareholders, right? So you're made whole because you're losing value in the stock, but you're getting money back. But it does create sort of this weird artificial gap every quarter on the chart of AT&T. And if you're analyzing a technical indicator like RSI or MACD, I would argue, and John Murphy, one of my mentors, would argue very, I think, correctly, that having these weird gaps just because of a dividend payment aren't really good if you're analyzing technical indicators, because indicators should be based on investor behavior. So you want to strip out that dividend impact and just look at the buying and selling decision. Just look at the investor behavior and quantify that as you're analyzing the chart. So the adjusted data set basically adjusts the historical data when the company pays a dividend. So if they pay out a 25-cent dividend, basically all the historical data is bumped down by 25 cents so that it's still consistent with the current level. So when you adjust that data, you can see that AT&T is in line with the 2019 high after all those adjustments. But if you do not adjust for the dividends, you can see that it's actually well below that level, because again, the adjusted data set, it's adjusting all the historical data to be more in current price terms, I guess is how you would describe it. What's the right one to use? There's no right answer, to be honest with you. I've been doing this a number of years. I actually use both. So on stock charts and on most platforms, you have the ability to switch between adjusted or unadjusted data. If you're looking at a lot of technical indicators, if you're trying to analyze total returns, adjusted data is much better. If you're just analyzing support and resistance levels or Fibonacci levels or things like that, the unadjusted data is much better. But that's why the charts can look different. If a stock does not pay a dividend ever, the charts would be identical, because this is just adjusting for like dividends and like splits and stuff. People usually adjust for that no matter what. So this is just adjusting for dividends. So there's no real right answer. Some people are really, have a fervor about one versus the other. I think different ones are good for different purposes. And I've talked to a lot of people and have kind of come to that conclusion over time. But that's how you do it. And on stock charts, by the way, add the little underscore before the ticker, and that will do the unadjusted data series. Or below the chart, there's this little selection that says adjust for dividends. If you're using another charting platform, there's a default set somewhere in the system I'm sure you can access to. I know like on Bloomberg and Optima and others, there are places where you can make those adjustments. You just have to figure it out. Next question, could you take a look at Tencent, TCEHY, and educate me if the monthly chart is a potential head and shoulders pattern, which is what I'm seeing. And thanks so much for mentioning that you love the show. I appreciate it so much. Again, it's been a real joy kind of getting back to doing a daily market recap show. In case you can't notice or don't notice, I really enjoy doing this, and I'm glad to be back. So we're looking at Tencent Holdings. So Tencent's a Chinese company. And so, we have this gap higher that we've seen in the last week. So I would say, first off, I'm grading myself as a market commentator. I haven't talked much about China on my show yet at a time when China gapped higher. So that's I'll grade myself pretty poorly on that. I need to make sure that I'm monitoring non-US markets a little better than I have. I'll try to improve on that one for sure. But China in general has spiked higher, and this is post-Fed in the US. The Chinese government's made some changes to economic policy as well, and is really juicing Chinese stocks to the upside in a very short period of time. So I would say, a big part of what you're seeing on Tencent and a lot of other Chinese names is less about a company-specific phenomenon and more about a broader improvement in China. Sort of a rising tide lifts all boats. I think you're seeing that for sure. Now, you're talking about the monthly chart. So starting with the daily chart, right? I mean, I think the gap higher that you see on Tencent is important because we're getting above that May peak. And I think for me, it's, eclipsing a previous level of resistance is pretty meaningful. The weekly chart shows you how that April high, which is or May high, which we just eclipsed, lines up pretty well with the 2023 high. And I should actually listen to the answer I just had to my own question in the previous answer there. So unadjusting the data here, which is better if you're looking sort of the long-term resistance levels. You can see it's around $52, $53 in early 23 and mid 24. I'm just broken above that. So I think that's a pretty impressive breakout. We're also clearing the 150-week moving average, which can be important as well. Now you're asking about the monthly chart. So let's look at that. Yeah, so here we're looking at the monthly chart. You're saying, is this a big head and shoulders top? And I'm guessing what you're seeing is the head, the left shoulder, and like the right shoulder. And your concern is the topping pattern. So number one, I would say I rarely look at monthly charts and think about a head and shoulders top. For me, that's something that's really more on the daily or weekly charts. Monthly charts, which you have to remember, these are, if you're looking at a head and shoulders top, like this is like a 6-year topping pattern. Personally, I don't see head and shoulders tops as a particularly meaningful phenomenon. Now, what I would say is just the general trend is important. So are we making higher highs and higher lows? I think on any time frame that's meaningful. And what a head and shoulders top basically is basically a lower high and a lower low, right? That's what a head and shoulders top is really telling you, is that the trend is changing. So the way that is the new trend is we need to make lower lows and lower highs. So the problem is for this to be a valid head and shoulders top. And again, I'm not a huge fan of doing it on this kind of time frame, but I'll answer your question directly. From the textbook would tell you need to make a neckline by connecting the swing lows, which would be the 2018 low and the 2020 low, which means Tencent needs to get all the way below there to confirm the head and shoulders top. What you have to remember is a head and shoulders top is only confirmed if and when you break below the neckline. That's when it's actually a completed pattern and when you can validate that as the signal. For me, when I'm looking at the monthly chart, it's more these trends that I'm observing. And I think what I'm seeing most recently is a higher low and now a higher high. So, I think for me, looking at the monthly chart, this is the more important trend to be focusing on. This is one of those where it looks like a pattern, but I don't think it really is. For me, it's more tracking this sort of uptrend of higher highs and higher lows and betting on that to be the primary trend until that trend line is broken. And that's when I would be sort of concerned about it. But the monthly chart really has turned positive. The monthly PPO or the monthly MACD is bullish at this point. I would say the monthly chart is more bullish than anything. But I think that's the pattern that you're seeing. Again, monthly data looking at 6 years, I think is too long. The head and shoulders kind of pattern, if you go back to like the classic books by Edwards and McGee, and if you're looking for the classic books, by the way, go to my website, Market Misbehavior. I'll bring it up, marketmisbehavior.com. And then in the upper right, go to reading list. This is my recommended reading list with things that I have found helpful. If you're looking to build out a library on being a better investor and a better human being, I would encourage you to take a shot there, and you'll find some interesting books. But Edwards and McGee, which is one of the books on that list, would say that's probably like a 3 to 6 month pattern on average. I think that's too long of a time frame. Next question: why is the McClellan Oscillator going negative? I love this question so much because, I think, for me, I always just assumed technical indicators were what they were, and I just sort of followed them. And then I had an analyst, shout out to one of my former analysts, Ching Tan, who still in the Boston area, was one of my analysts at Fidelity for a number of years. Just, one of the smartest people I've ever met. And just a scientist. He approached the market as a scientist, as an engineer. and again was just a very cerebral analyst and still is to this day. And he talked about, he would talk a lot about not just what the indicator was saying, but what the indicator was doing, right? What were the numbers behind the indicator? Because he would try to think about what would need to happen in the market to make the indicator do a certain thing, which I just thought was a whole like meta level of how to use technical indicators. Not just here's the signal, follow the signal. It's like, wait, let me understand what's happening underneath there, because then I can start to think about potential future outcomes and what that might mean for the signals that I'm following. And I think that's brilliant. That's kind of what I think you're implying with your question. This is the chart of the McClellan Oscillator on the chart list, the Mindful Investor Live chart list that I mentioned that we track. And your question is, what's causing it to go negative? So it gets back to the calculation of the McClellan Oscillator. I'll explain what it is briefly, and then I'll show you where you can get more information on indicators like this on stock charts. It's a free resource called Chart School. What this indicator is doing is it's an indicator based on advanced decline data. So the chart that I would start with is this chart, which is the raw advanced decline data. So this is a chart tracking the cumulative advanced decline line for the New York Stock Exchange in the top. Let's just leave it there, right? So this is doing every day how many stocks are up, how many stocks are down. That's your daily advanced decline reading. If you take those as a series and every day add a positive number or subtract a negative number to the running total, that becomes the cumulative advanced decline line. So it's looking at the daily advancers decliners data, and then stringing it together to get a data series, a cumulative advanced decline line. That's a really good, just simple way of analyzing the trend in advancers decliners over time. Instead of just looking at a one-day snapshot, let's look at it over time and see, generally speaking, are we seeing more up moves or down moves over time? But what Tom McClellan, who's a market strategist today, his parents, Sherman and Marion McClellan, I think her name was. Sorry, Tom, I think that's your mother's name, Sherman and Mary McClellan. But basically, they were market strategists back in the day and created what's called the McClellan Oscillator, which is basically turning that cumulative advanced decline line into an oscillator, right? Sort of an RSI for breadth, for lack of a better term. And the way they do that is basically using moving averages of the advanced decline data, similar to the MACD indicator. If you're familiar with that, it's looking at the spread between two moving averages. And by doing that, they're able to look at the change in the advanced decline data and plot it as an oscillator. There are a couple different ways that people use this. I use it primarily looking at when we go above or below the zero line as a main indicator. And when the McClellan Oscillator is above zero, that means the short-term breadth is bullish. When the McClellan Oscillator is below zero, that means the short-term breadth is bearish. That has often been a really good indicator of short-term swings because the breadth will turn negative and the market will sell off very, very quickly. It's not perfect. And particularly in the last 12 months, there have been times when it's just been completely backwards and the market rallies on weaker short-term breadth. And that's been more about the leadership. So this is like January of 2024, when the Magnificent Seven trade was reignited. When mega cap stocks are in a leadership role, this becomes less meaningful because it's looking at breadth data. And if it's not a breadth, it's not a broad rise, but a narrow rise for mega cap stocks, this indicator is not going to be as bullish as you want it to be. Now, having said that, I still think it's super important to follow. The other thing would be divergences, which, if I go into here and bring it back, the color coding might not look pretty here because I'd manually update that. Those bars. That's why it looks kind of wonky here. So sorry for that. But if you look like back in 22 to 23, you had a lot of these divergences, which were also meaningful, right? Where the market would keep going higher, the McClellan Oscillator would be above zero, but it would be diverging, right, making lower peaks. And that was often a good leading indicator of a downside rotation. So I've followed this indicator for years and years, looking at those two things, primarily when it flicks above or below the zero line, and then number two, if you have divergences. And the reason why I think it's important to note here is because this is one of the three components to the Hindenburg Omen. We talked about that earlier this week on the show. So if you missed that, go back. I think it was Wednesday or maybe Thursday. We dug into that a little bit. But the Hindenburg Omen has three components. One of them is the McClellan Oscillator breaking below the zero line. And so that's why I think it's super important to track now, because we've had an initial signal in early September. We have about another week or two before we need another confirmation signal from the Hindenburg moment to have a valid sell signal. Last time we had that sell signal was at the end of 2021, before the 2022 bear market. So kind of an important one to watch. Boy, folks, that's all the time we have. It goes so quickly here on Chart This, but I appreciate you so much joining me every weekday after the close for our show. We've so enjoyed getting this show back up and running in the new format, new look. We appreciate all your thoughtful comments and feedback, really striving to improve things. Just so you guys know what else is coming up, we do have a new interview show that we're working up here, sort of working with some potential guests, just figuring out all the logistics. But hopefully in the next couple of weeks, you'll start seeing interviews on our YouTube channel called Market Misbehavior. So make sure you check that out. And also a lot of other great ideas for content and other stuff for the channel here. So thanks so much for watching. For Market Misbehavior, I'm Dave Keller. And remember, it's always a good time to own good charts. Have a great weekend.